Good. Okay. Well, I will uh, go ahead and call to order this special meeting of the City Pension Fund Board. And the meeting is, because it's a special meeting, the only item on our agenda is the presentation by Allison Corbally. And then I think you'll bring in Surya, right? Um, on our pension fund, and you all should have received the packet in by email. And I don't know, Allison, if you're going to put it up on the Zoom or
Yes.
not, but welcome everyone. And I just, before we get started, want to say formally in this meeting how very sorry we are about the passing of Gay Lang, who was one of our members. And so Samantha's got a process going for an election, and then we'll see how that goes. But we want her family to know how sorry we are. So we have a quorum. So Allison, welcome.
Thank you.
Good thing you didn't have to fly down here. We had a major thunderstorm this morning.
It's coming our way in Atlanta.
Okay,
So we're getting
okay.
it later this afternoon.
All
So
right.
hopefully we won't have any technical difficulties. And we do agree, we like to meet in person. The committee voted to move to a Teams-oriented quarterly review meeting, which it is efficient, particularly when you're trying to achieve the quorum. But we are happy anytime to have an in-person meeting. I'm in the area because we work with Greater Clark Foundation, so more than happy to set up in-person meetings at any time the committee would like to do so.
All right, thank you. All right.
Okay, so just a reminder, the intent of the special meeting today was a result of conversations we had at the first quarterly review meeting and the discussion around the asset allocation of the portfolio. The portfolio is currently a 60% equity, 40% fixed income exposure. That 60% is a major chunk of that is in US equities, and also you have non-US equities as a component to that. And Dave is on vacation this week, and I've asked Surrey to come in because I guess, first of all, as we were talking internally at PFM AM regarding our conversation, Dave and I were both scratching our heads like, let's make sure that we know the intention of the committee and what they're trying to achieve. I heard from the discussion that the committee was a bit leaning towards potentially increasing the equity exposure in the portfolio. In that conversations with Surya, she's like, they're over 600% funded. They really want to increase their equity exposure. So we thought we would come back and get at least, and we have materials to go any which way on our conversation or in the direction of the committee, but if we're not mistaken, the consensus was to increase the equity exposure a bit in the portfolio. Is that the case? And if, please, for clarification, so we have a very productive conversation, share with me your thoughts.
I do think, if I recall, and other members can weigh in too, that was part of our question. Should we do this? Should we do a reallocation? And some of you may remember more specifics, but I think it was kind of a conversation around that. Does anybody else want to add anything to that? There was no decision made, but we did want to be sure we are doing what we think we should do.
Okay. So what we've prepared was we have prepared a presentation with some slides speaking on a big level about the evolution of the markets, specifically on fixed income and equities, US and non-US equities, and really taking a stepping back and looking historically at the returns of these three primary asset classes and what the results have been based upon your exposure or a balance of that exposure, and then what that would mean going forward as we talk about the asset allocation. And we did put together your current asset allocation, intermediate and long term, and then we've also put together some other models to look at. But we thought it would be in the best interest to have first this conversation just about the markets and just about the risk return inherent in the various asset classes. So does that sound okay to start with?
Everybody good?
Okay, so I'm going to pull up our presentation, which was distributed, and I'm going to have Surya kick us off. She's going to talk about the markets. And can everybody see my screen? Yes, no?
Yes.
Perfect. Okay. All right. Thank you. Thank you, Surya.
Thank you, Allison. Good morning, everyone. I'm glad to be here. When Allison kind of talked to me about this, I thought these set of slides would be an important, would kind of make sense in this conversation because this is something that we put together earlier this year. And every time we've presented it to clients, we've gotten a lot of good feedback because this kind of lays down the historical context of how markets have worked over time and what to expect from markets over a period of time. And we thought that would be an important context to lay out here before we discuss the asset allocation study in detail. With that, the first slide here shows just the growth of $1 million. What this is saying is if I took $1 million check or if I opened up an account with $1 million in it, and if I invested all of it in Russell 3000, my returns today or my account balance today would be somewhere around 40 million. That's the orange line for you. But if I had taken that and put it in Bloomberg US Ag, which is core fixed income, my returns today or my account balance today would be somewhere around 2.5 million. And then if I'd taken that and put it in international equities, which is represented by the blue line, which is MSCI ACWI World X USA, it would have been around 7 million. What that goes to tell you is how strong US equity markets have been, especially since the end of financial crisis. What happens is the end of financial crisis is that we saw this massive tech rally here in the US. If you think about it, most of that tech innovation was concentrated in the US. The Mag 7 kind of grew here in the US. The iPhone kind of grew here in the US. So as a result, you saw that reflected in the market cap of US equity markets, which is what's reflected in that orange line. And similarly, today, most of the AI companies are here in the US. And as there is this optimism around AI that is being reflected in the US equity markets, which is again why you've seen that almost almost vertical upshift in the US equity markets compared to international or fixed income markets. But that's the longer term snapshot. Now let's look at it on an annual basis. Because when you look at it at an annual basis, you have to sit through some of the volatility that comes through from an annual basis. Well, yes, we've had very strong 2023, 2024, or 2025. But then think about 2022, when both equity markets and fixed income markets sold off. Over shorter periods of time, market kind of throws out this volatility that we all have to stomach in order to gain over long term. A good example of that is, again, going back to 2000s, early 2000s. We had strong equity markets from 1995 to 1999. I'm looking at Russell 3000, and we're looking at numbers 36.8, 21.8, 37, 31.8, 24, 21, So Russell 3000, which is a reflection of US equity markets, had a strong run. But what came after that was the bursting of tech bubble, which is when we ended up with returns of negative 7.5, negative 11, and negative 21. The orange chart on the prior line does not necessarily reflect that for us, but when you kind of take a step back at those shorter intervals, there is a lot of volatility that investors need to stomach. And then the question is, do you kind of stay invested during those periods of volatility, or do you just focus on the long term, which is the next slide here. Um, Sorry, actually, let's go down one slide. I should have it pulled up here. This one, and then we'll come back to the next slide. What this is telling me is that it's very, very hard to time the market. If you were taking 1 million and investing it in the market since end of 1995, and if you said, take out all the top 10 days of S&P 500, because, uh, the market's at the top, I'm getting worried. I don't want to stay invested in the markets. And the market goes up further, that's what it happens, right? There's momentum, and momentum kind of builds further. And then we typically see that the market reaches an all-time high and then it goes up furthermore. And then there is some catalyst that comes through, there is over optimism around some of these things, and then they're not delivered by the companies, and then the market sells off. If you miss the top 10 days of S&P 500, that is, if there is a way for us to time the markets, and then we say that, what, the market's at top, let's get off the market bandwagon, your annualized return kind of goes down from 10.35 to 7.4. If you miss the top 20 days of S&P 500, it goes down to 5.5. And missing the top 30 days in the last 30 years brings down your annualized return of your investment from 10.3% to 3.8%. So we're talking about 6.5% annualized return that's lower as a result of missing out on these top days. So what this goes to say is for investors to stay in the market over long term, kind of not be unnerved by what comes over shorter term. And then going up one slide, you kind of see that across these different markets, the other thing that also works is diversification. Because over shorter term markets do throw up these periods of volatility, it makes sense to be diversified across asset classes. So Allison, if you go up to slide 5 there, this looks at calendar year returns across different asset classes. For 2023, 2024, it's no surprise that US large cap equities are at the top. The orange is the best performing asset class. But then there are time periods where, cash is the best performing asset class, like in 2022 and 2018, or EM equities are best performing asset class in 2017 and 2025. And for us, when we're thinking of building longer term portfolios, the idea is to diversify across each of these different segments of the market so that you end up in the middle. The middle is that white box. White box is basically looking at asset allocation, saying, where do I land with 60% growth and 40% income, or 60% geared towards equities and listed real assets and 40% geared towards capital preservation and income generation? You kind of land somewhere in the middle. You're not at the top, but you're not at the bottom. So the big theme here is the markets tend to work over long term, over shorter terms. There are periods of volatility that we need to stomach. The best way to address all of that is through diversification, which helps the portfolio offer that steady stream of returns over longer periods of time. Now, thanks, Allison. There are a couple more slides just talking about US equity markets. And this is in reaction to the questions that we typically get, especially now because we've seen markets run up so much. So the question is, what does it take for markets to sell off? What happens when markets sell off? How long is the duration of a market sell-off? So we kind of put this together to show the frequency of a bull and a bear market. Bear market is when the market is down over 20%. In any given year, it is fairly normal for the market to go down by 10%. It happens every single year. It is just that we don't notice because when we get to the end of the year and we look at, say, 2025 return or a 2026 return, we're looking at a positive number, so we sometimes tend to forget. For example, last year during the whole tariff uncertainty, we saw markets sell off and S&P 500 being closed down to 20%. Or, go back to the COVID scare. The market was down 33%, and then it came back up strongly from there. So it does, when the sell-off happens, it happens over a very shorter period of time because there is this uncertainty that market is unable to digest. And as a result, the first thing that investors do is to sell off risk assets. But that doesn't mean that every bear market tends to be shorter term in nature. Going back to COVID time frame, so February 19th through March 23rd, 2020, the market was down 33%. The duration was only 1 month. But then if you go back to 1980s, where we had the double dip inflation scare, which is basically, the inflation was very high at that point, energy prices were going up. The market was down 27%, but that happened over a period of 20 months. And what tends to happen is coming into the bear market, your average annualized return tends to be high. So let's think about 2000s because we referred to it earlier. Coming into 2000, if I had invested from 1980, my annualized return would have been 14%. But after those sell-offs that we saw across those 3 years, my annualized return would have been only 9%. Today, when we look at the investment, the reports, right, the quarterly reports that get produced, you can see that the 1 year returns in that 20% range, 3 year return is in that 15% range, 5 year returns again in that 15-17% range for US equity market. All it takes is one sell off to kind of adjust that 15% to an 8% or 7%. So all I'm saying is that over long-term fundamentals matter, and because it's backed by strong fundamentals, markets do outperform over long terms. But over shorter term, there is volatility that investors need to be able to stomach if they are taking on greater risk within the portfolios. And then the next slide is just laying it out further in terms of bear market versus correction, which we could possibly skip because it's just I put it in there just so that if there were questions, we can go over that. Let's just get to the next slide here. So I talked about, the market drawdowns, shorter term volatility, and then what happens across different asset classes. We looked at that quilt chart that showed us that different asset classes perform differently over time, and diversification is important. But what happens over longer term is that when you combine these different asset classes, your return tends to be a combination of that, higher growth and higher income, both of them kind of supplementing the portfolio. So this we've done by looking at snapshots of 10-year rolling return going back to 1998. So if the portfolio were invested in 60-40 over a period of 10 years, so think about that 10-year line in your report. Over a period of these 40 years, if I had invested in a standard 60-40, what would have been the worst return observed and what would have been the best return observed? So if I look at my 60-40, the worst return observed was 277 and the best return was 1234, and the average being 7.5. If instead of 60-40, instead of using fixed income as that downside protection, I had taken that and invested 100% equities, my worst return would have been 0.3%. And mind you, 0.3% over the course of 10 years. So, and that's why, the first decade of 2000s is considered a lost decade, because if you had invested at the beginning of 2000, and then if you looked at your money at the end of 2010, you would have been closer to that 0.3. We had the sell-off during 2001 to 3, and then we had GFC. Um, so when we take on that risk in the portfolio, what tends to happen is that you could be experiencing that level of downside, which is reflected in that 0.3% over 10 years. By the way, the best return that could be had is 14%. So similarly, the range of outcomes is fairly wide, and you can have the best return at the higher end, but you're getting the worst return at the lower end just because of the nature of equities. But as you add in a little bit of fixed income for capital preservation purposes and for diversification purposes, the return stream does get narrower from that super wide, 0.3 to 14.4 narrows down to 0.9 to 13.7. I add 20% fixed income, it narrows down further from 1.6 to 13.2. That's the range of outcomes. And then at some point, though, you do see that, your overall return does fall because you want to take on some risk in the portfolio in order to meet your return requirements. So I'm not arguing that everybody should be in 100% fixed income because, again, you're no better off than, excuse me, 5% in the portfolio from an average return standpoint. Um, and most plans have a return requirement of around 7% because discount rate tends to be in that 6.5 to 7.5% range for most pension plans. So it does make sense to kind of take risk within that, around that 60-40, and which is why when we do capital market assumptions and we come to you with our asset allocation study, typically that's where most of the portfolios end up. Again, there are individual constraints at client level, but when we look back historically too, the data is supportive of the fact that taking on just equity risk exposes you to greater variations in return. Adding in a little bit of fixed income narrows down the range of outcomes, but still allows you to access returns in order to grow the portfolios. So with that, though, I mean, that's all I had. Just from a broad standpoint, I just wanted to frame how we're thinking about markets and how to think about risk, because risk could mean different things to different investors. Risk could be standard deviation, risk could be loss of capital, risk could be the range of outcomes. I want a smoother ride. Could be a way of saying I want less risk in the portfolio. Or the fact that, I don't want to lose as much as the market might be another way of thinking about risk. So I just wanted to frame the conversation here today before Allison talked about asset allocation study. With that, I'll pause talking and see if there are any questions.
Okay, does anyone have a question about what we just covered? No questions? Okay,
Okay.
right. Thank you
So I'm
so
gonna-
much.
I've got
Thank you,
one.
Sue.
I've
Oh, yeah.
got one
David.
real quick.
Dave has,
Yeah.
you're not on my screen. I couldn't
Oh,
see you.
Sorry. Hey, why did you pick the Russell 3000? Was it Russell 3000 versus S&P or the Dow or something like that? Or are they all the same?
More or less we'll end up with the same numbers. We picked Russell 3000 for most of our analysis because Russell 3000 is the benchmark for domestic equity sleeve across our client portfolios, and it includes small caps. If we did just S&P 500, then we're excluding small caps, and given that small caps are a part of our strategic asset allocation, we just wanted to show Russell 3. But there are a couple of other places where we've focused on S&P 500, and that's just depending on the data availability and what's easily accessible to us to put together that data.
Got it. Thank you.
Are there any other questions? All right, I think we're ready to move forward.
All right. So thanks, Surya, for that conversation around the markets. We did go ahead and put together an asset allocation modeling for the portfolio, the pension portfolio. As Surya said, we used capital markets assumptions to do this. These asset class assumptions we put together on an annual basis. They're not purchased or outsourced. It's internally derived by our research team, and through our research team collaborating with our investment committee, which Surya is a member of, the investment committee actually approves the capital markets assumptions going forward. We take a look at 2 time periods. One would be intermediate, that's 5 to 7, and then long-term assumptions would be anything up to 30 years. Very forward-looking. We incorporate current valuations, corporate profit growth, and economic fundamentals in calculating or assessing the capital markets assumptions. We don't see, because we run it annually, you don't see much deviation from year to year, just because you're looking out long-term on the nature of the assumptions for the asset classes. If we focus on the first column, this is Lexington's at current asset allocation, which I mentioned before, 60% equity, 40% fixed income. The balance of that 60% is a combination of US equity and non-US equity. And core bonds would be an exposure to the Bloomberg aggregate. The intermediate, we look, this is a 50%, 50% probability, but the expected rate of return on an intermediate basis is 6.4%. with a risk inherent, or what we use the standard deviation of 9.9. And if you look at long-term, that assumption to 30 years, the return goes up a bit to 6.6%, and the risk stays the same at 9.9%. The 3 additional models we've included in the forthcoming columns are a little bit different in asset class exposure than your current 60-40. The column to the right of your current model that says 60-40 model, the model equates to us incorporating listed real assets. And listed real assets would include real estate investment trusts and listed infrastructure. Why would we include that in the portfolio? Well, we look for asset classes that lack correlation, moving in the same direction as other asset classes. We saw this in 2020, where the fixed income markets and the equity markets, both international and US, moved in the same direction, negative. We look for listed real assets to add diversification to the portfolio, and has a little bit of a fixed income feel to it and or an equity feel to it. If we look at a 60-40 model portfolio, we would be moving 6% from your equity exposure to listed real assets. And on the fixed income exposure, redeploying 3% of your core fixed income, which is the aggregate, which is a Bloomberg aggregate is the benchmark, primarily consists of treasuries. We would add high yield bonds as an exposure of 3%. And if you look down to that yellow part of the chart, you can see that there is not any change in the forecasted intermediate rate of return nor the long-term rate of return, but what you do achieve is a lower risk profile. And thus that's what you're going to get by including listed real assets. And then if we move to a 65-35 model, 70-30 model, both of these models include listed real assets. The difference is the 65 represents a higher exposure to equities, and the 70, the highest exposure in this chart to equities. And ultimately, what you are going to see is intermediate and long-term, you have a probability of achieving a higher rate of return, but you're taking on more risk in both the intermediate and long-term. So if the committee if you were happy with what we were achieving for your objectives for this portfolio through the discount rate, then an option would be to incorporate listed real assets just to bring down that volatility in the portfolio and increase the diversification in the portfolio. If you wanted to choose to ramp it up with a higher potential of absolute returns on the intermediate and long term, then the decision may or the consideration would be to increase your equity exposure in the portfolio.
And Allison, if I may add to
Yes,
that,
absolutely, sir. Yes.
in each of the other models, in each of the equity ramp up options that we have shown here, we have included listed real assets because our intention is to suggest that asset class diversification is important. If you're considering taking on more risk, consider taking it in an incremental fashion so that you're not fully exposed to equities, but then you are exposed to other parts of the equity markets that tend to have less correlation to broader equities. And the last thing there is that we are seeing other clients kind of think about it, just because where equity valuations are at today, I've showed you that orange line on the first page going all the way up. And as a result, where equity valuations are at today, we also think that it does make sense to diversify away a little bit within the risk bucket. Again, by adding listed real assets, you're not necessarily reducing overall risk. It's not like fixed income, but where it is, it's somewhere between equity and fixed income with some fixed income characteristics, because there is the yield component associated with REITs and infrastructure. And then there is the growth component associated with their underlying cash flows, which again tend to be driven by, the some of them are driven by, with REITs, it's driven by economic cycle. The economy is doing well, REITs tend to do well because the underlying cash flows tend to do well. But these are idiosyncratic cash flows and not necessarily, just driven by the broad AI cash flows. Again, I should caveat it by saying, yes, there are data centers within REITs. Yes, some of the utilities are providing services to these data centers, and they might be beneficiaries of all of that. So, but at a broader level, as we think about what would drive the returns of each of these asset classes, we kind of see them as something that's offering a little bit more diversification to the portfolio than just being in equities, all the way up to 70%.
We
May
did in
I-
the
May I ask a question just of Samantha? Samantha, how many, and this is kind of a tangent, how many beneficiaries are left in this fund? Do you remember offhand?
I don't remember.
If you don't,
exactly
it's
offhand. I
okay.
believe it was 17 or under.
Okay, if that's okay. Thank you, because I think for purposes of discussion, we don't want to look at 30 years, right? And I don't know. I'll just kind of leave it at that and let you all go on, unless there are other questions before we go on.
Mayor, we have
Yes.
23,
Okay.
recipients in the plan.
Okay, very good. Thank you.
And could you just tell us really quick, how old is the youngest one?
I would have to run a query, but I think our average age is probably going to be around 84, 85.
Okay. And then could I just ask a question internally? We have that liability defeasing portfolio and the other portfolio. Are you talking about this mix across all of them, or you talk about just in the not the liability defeasing portfolio?
Yes, David, you're correct, the latter.
Okay.
Mhm.
Okay.
Just for the risk-seeking portfolio, not the asset liability portfolio, diffusing
Okay.
portfolio.
Okay.
All right, any other questions before we go ahead? Okay, thank you.
And I would suggest that regardless what the committee decision is, whether to stay where you are at 60-40, which is absolutely your prerogative to do. We certainly aren't promoting against that or suggesting that, but I would suggest that the investment policy statement goes through a refresh in itself. It's a bit outdated, and from a nomenclature perspective and just some verbiage, I do think it's worthwhile from a governance standpoint and as fiduciaries to just to work through that and have an updated copy.
Okay, remind me when that was last done. I thought we redid it maybe within the last 5 years
2 years ago.
2 years
Yeah.
ago.
Okay,
Okay,
so the latest one I have is dated
I thought it was fairly recent.
Yeah, I think
Two
we
four-
looked at it, 2 years ago, if I'm not mistaken. Susan can correct
Mhm.
me.
Yeah,
Okay.
it will, I think so. So I think I
Mhm.
do think we changed it since
Okay,
I've
that's
been
my
on this.
mistake. Okay.
Mhm.
Let me
We-
search internally here. If not, I'll circle back to Samantha if we can get an updated copy. I'm sure we have one here, though.
Okay, good.
It would probably have a horse on it. Instead of seal.
That's right, that other one didn't have a horse on it.
That's right.
Aha.
It may be 3 years ago now. Things are running together, but here longer
It
than
was
I
in
realized at this
2014.
point. But
Okay.
I think it's at least been in my tenure because I was on
Yes.
that group.
And I think the council members, except maybe Councilmember Curtis, I'm not sure if you were on it, but I think Councilmember Baxter was, Councilmember Savigny, you were, weren't you? I mean, we all kind of remember that because it's fairly recent. So anyway,
For sure.
okay. All right.
Any questions, comments?
Are there any other questions or comments?
I think when you're talking about the alternatives, the REIT, like I actually just went through a conversation with this on another one of these. So in general, I think what you're saying is the alternatives you pick are somewhat contrary to I mean, they tend to be maybe a hedge against something or something like that. Is that they don't really act with the market as much? Is that correct? Or what? Or is that wrong? A wrong assumption?
No, you're right. But I just want to make the distinction that we would not necessarily call these alternatives. When we're saying alternatives, we're typically referring to private capital strategies, where you're kind of getting that idiosyncratic return profile a little bit more because they're not traded on any equity exchange at all.
And
These, the
illiquid.
listed REITs, listed REITs, if you look at the names under listed REITs, they're part of Russell 3000 universe. The listed infrastructure is part of MSCI World. All we're doing is taking a small sliver of the broader benchmark and allocating to it separately. So since these are publicly traded securities at the end of the day, what tends to happen is, if there is this big rush of money out of the market, they might be temporarily impacted, which your private alternatives would not be because nobody is valuing them on a daily basis. They only get valued on a quarterly basis. So that's the distinction. So I don't want to say yes and then mislead in any way. I would say that, but the underlying drivers tend to be slightly different than the broader equities, which is where we think the distinction comes through. For example, earlier in the year, listed infrastructure did really well. So far this quarter, listed REITs are doing really well because, there's this rotation that's happening into small cap and value stocks. So they have been doing well. They do tend to react to macro factors, to interest rates matter, economic outlook matters to these, but they do offer a diversified return stream.
Okay, thank you. And then are the things that you're showing the estimates all net of fees?
Allison, you have to put the thing back
Oh,
on.
sorry. I'm pulling up.
We're seeing your Teams chats.
That's okay. I mean, I'm not hiding anything. I was trying to pull up the
Yeah.
Wait, hold on, let me stop and then pull it back. I was trying
Okay.
to pull up the market returns, just so you can get an idea what the listed real assets were returning. All right, let me pull this back up.
Sorry, and sorry, David, your question was
Yeah, were your returns listed as net of fees? That was just a question. Is it net of your fees, or is that just market?
Just market.
yeah, the way we go about doing our capital market assumptions is just saying what's that one
Yeah, I
return
get it.
number that we want to average this to, and then yes, once we get to vehicle implementation, right? You have your manager fees that they're charging, and then we have our fees on top of it. And
Right.
then every year we've been, I would say, like, for the last 5 years, if you go back to 2020 and then run our CMAs and then look at it in 2025 and say, hey, you guys missed it. You said 7% equities are at 20%. We understand that. But when we're thinking about it, we think about it in a very conservative fashion. We're only accounting for what's driven by fundamentals and not necessarily accounting for a SpaceX IPO coming in and then ramping the market up or something else happening in the market. But conservatively informed by fundamentals, what's that one number that we can put our weight on today? And that's how we kind of think about that process.
And just think we've come on the heels of 3 very strong years in the equity markets. And so we've not forgotten about 2022. And so this is a way in which just underscoring the diversification in the portfolio and the lack of correlation it adds to the portfolio. As you can see here for the quarterly market summary, and this is the chart we shared at our QPR for the first quarter. You can see just the difference in returns under listed real assets for the year to date and 1 year versus the equity markets and the fixed income markets.
Any other questions?
Sorry, I just had one comment, and maybe Allison was going to get to it, but as you kind of think about the reconfiguration of the portfolio, another thing that might be worth considering is active versus passive. And I know the portfolio is currently allocated to MMSD funds, but going back to David, your question, right? The expectations based on at the gross level, but is manager fees a consideration? What's committee's view on active management versus passive? And are you inclined towards taking on that, I wouldn't say volatility, but the whole reason of active is that, you do have quarters where it outperforms and you do have quarters where it underperforms. Is that the kind of ride that you would want, or you want something that's very close, very tight to the benchmark? So that might be another question to consider as you're thinking through as well.
Regardless of the asset allocation, it could be a consideration for the committee for passive exposure for the equities versus active. And you currently have a mix of passive and active in the equity portfolio.
That's kind of where I am sorry, I raised my hair.
No.
That's kind of where I was thinking this conversation might lead. Because Allison is very well aware, we struggled to outperform anything over the last quite some time with active management. And so the question becomes, what are we paying for? And apologies, but we are the fiduciary. We have the fiduciary responsibility to make the best decisions. And so, more diversification when we're not necessarily outperforming where we are just doesn't necessarily seem like that might be the direction that I would naturally be inclined to go. I think when we kind of looked at our opportunities with this fund, we are looking at it potentially in a relatively shorter term here, but we're not necessarily looking at it in a short term forever. It will just live in a different place. So we are looking at it as long-term opportunity for the city overall. And our other funds are invested in these REITs and these other, real estate opportunities, and they do well. But kind of is the juice worth the squeeze on the short term here? I don't know. But this one just seems to struggle a lot more, and I'm not sure why exactly that is, but I would wonder if it's really our asset allocation or if it's really worth trying to, put more buckets. What I was looking at with this one is we are well funded. We are meeting the obligations of our members. We want to continue to do the COLAs and try and keep pace. And, as long as we're continuing to do that and we're meeting those needs and doing that well, if we had, and this was the sense that I got from the group, if we had a little space to take a little more risk and earn a little bit more, I think we were interested in maybe entertaining that.
Mm-hmm.
Continuing to make adjustments to be less risky was not the direction.
Mm-hmm.
But if we're gonna not do that, then all bets are off and we go back to just, do we even want to continue down the road of being actively managed?
So
That's a lot.
I picked up a couple of things from that, Erin, and it's very similar to what you brought up at the quarterly review meeting, and that was the dissatisfaction of the overall performance. And we're going quarter to quarter,
Yes.
taking, looking at our active managers, will they outperform?
Yep.
And the bigger plan has a different benchmark than we have on this plan. It is different. But the looking at this particular plan of consideration would be allow yourself to sleep at night and go to a passive exposure for the equities. So you're going to get the market return. And with that, you also could lower the underlying fee because you're taking an index or passive approach. We would still do the asset allocation, looking at opportunities to overweight, underweight within the construct of your investment policy, but we wouldn't utilize active managers. So we're not paying the fee for active managers, and we would use an index and ETF for exposure. Another also to that, if you wanted to go more risky, then you could leg up on the 65-35. We're taking a little more equity risk, but we're taking the market risk. So that's another, but and Surya is aware of this, being on the investment committee, and she's been at the committee meetings before defending, our strategy. But we realize that we need to deliver on what you have hired us to do. And if there's a way that we can get you to sleep better at night and to retain this relationship, and able to achieve your objectives, that is a consideration the committee may want to look at.
Well, and we know it's your all's responsibility to manage expectations and provide balance too. I know that you all get screamed out when the market goes down, and then people go, "What happened to my money?" We know that you're on the receiving end of that all too often. So you're treading cautiously. So I do want to be aware, that you do experience that more often than not. So we do appreciate that you are treading lightly for a reason. So I don't want you to think that we don't appreciate and respect that as well.
I just want to say I appreciate, Erin, your comments because they kind of reflect where I was thinking. And the thing about this fund is, yes, it could be in place for a long time living in a different place, but there are other alternatives that may, once we get this committee going, that may change that a little bit. So, but I appreciate your comments on that, and I'll ask if there are others. What are you thinking, members? Do you kind of agree with what Erin said, or Um,
Yeah, I mean, I'm generally in agreement with everything Aaron was saying.
Whitney,
Yeah, I
you
think
went
it's,
off.
Can you hear me?
Mm-hmm.
I do think it's, I don't know that it is, that we are fulfilling our best obligation to this fund if we are paying a fee and not meeting those benchmarks like that I understand completely what Aaron was saying, and I think, we just have to, we just really have to think about what the bottom line is and if we can, um, sleep okay at night, like Allison said, knowing that we've done the best thing for the fund. So I think we've got some thinking to do.
And if I
Anything
may
else?
just,
Yeah, go ahead.
sorry, if I may just qualify what Allison said, our recommendation would be to consider passive in equities, but stay active in fixed income, where there is ability to generate alpha. You would have experienced that in your portfolio over the last few years. And it's something that's the nature of the fixed income market. It tends to be a little inefficient. Managers who do the credit work tends to outperform. So our recommendation would be to, if you're going down that route of passive, consider staying active within fixed income.
And probably adding the high yield exposure. We used to have high yield in the portfolio. It was out of benchmark exposure. It did add value to the portfolio, but we decided to remove it since it wasn't in the benchmark, the Bloomberg aggregate. And so in part of that modeling we showed you on the earlier slides includes that sliver to high yield. And with that, we'd show that performance versus the respective high yield benchmark, more apples to apples. So I would recommend that if you did go to the passive for the equities, as Sirius, highly recommend staying active with the fixed and then incorporating that high yield sleeve to the fixed income.
Any thoughts?
If we could take a look at the performance of those in particular over the last 3, 5, 10 years. That you're noting. I was trying to flip back. I've got my December pulled up and I was trying to look back on over particularly our fixed income.
The fixed income performance with the high yield.
Yeah,
Is that
and then
what you're saying,
you
Erin?
mentioned that we used to have another one that
We did have high yield in the portfolio as part of the fixed income portfolio measured against the Bloomberg aggregate.
okay.
And we used it opportunistically in the portfolio, the high yield exposure. And then the investment committee made a decision to have a permanent exposure into high yield because of the value it adds. And
Okay.
so with that step, then it was for apples to apples. If we're going to have this as included in the portfolio moving forward, we need to show it against the respective benchmark. So we can go back. A majority of the fixed income portfolio, if I'm not mistaken, Surya had high yield in it, with the exception of LAT for the past probably 9 months or a year.
Okay.
So it
Yeah,
really
and
is.
around COVID timeframe, we had tactically reduced high yield too. The reason we're recommending high yield today is because corporate fundamentals are fairly strong. The quality of high yield benchmark today is much higher today than it has ever been. So it gives us more comfort investing in high yield, and it's no longer what high yield used to be during the global financial crisis. And the market has grown to be a fairly decent chunk of the overall US fixed income market. So it gives us the confidence to bring it as a part of the strategic asset allocation. And what Allison's saying is, let's memorialize it within the IPS so that it's no longer a tactical allocation based on, our market view, but it's something that's allocated to in the portfolio at all times.
You can see the returns in the portfolio over the 2, 3, 5 year. and 7-year. And when you're talking out performance for fixed income, anything over 3 or 4 basis points is good, just because you're not going to get that incremental outperformance in fixed income because you're usually approaching it as a capital preservation exposure. And what really has helped is the active exposure, first of all, that we take in the diversification component of our fixed income portfolios, as well as a sector exposure. And one area would be the high yield. So I would say that if you look at our returns, 2 years and out, even 1 year and out, a lot of it just has to do with that full diversification. And a component of that is the high yield exposure.
Questions? Thoughts?
I was just wondering if for our next meeting, if we might be able to have some type of like example of what our fee structure would look like if we changed, if we made that change. I think that would be a good exercise for us to go through and just for comparison purposes.
And Whitney, would you, for that fee change, can we include high yield in that? And then the passive equity, is that what you would like?
Yeah, I think every kind of scenario that we've discussed, I think it would be interesting to kind of see them side by side comparison.
Okay.
Thank you.
I think that's a great idea. Yeah. Other thoughts, requests? Is everybody
think-
good with that? Dave?
Yeah, and I think what I heard you say though, Surya, is that you feel like in our, but I don't know that you have our current our current statement. You basically said it shouldn't, we should, if we're going to do certain things, it should not be like a prerogative. It should be just part of the base portfolio. Is that kind of what I'm hearing from you? Okay.
Yes, that's right, especially in the case of high yield. And what that would mean is that, assuming we stick with this MMST fixed income fund,
Yeah.
you have MMST fixed income fund, but then you'll also have high yield that's measured against high yield benchmark, and then fixed income fund measured against Bloomberg Ag.
Okay.
Yes.
Thank you. And then as things change, like when you give us our performance, are you giving us our performance based on the weightings that you had it at certain times? Like, is it an average? Because you move in and out of something. So for instance, let's say you were in 70% equities and 30% non-equities for a period of 6 months. And then this next 6 months, you were at 60% equities and 40%, whatever the other thing is. When you're giving us the benchmark, are you giving us the benchmark based on your ratios of how no? Okay.
I can address the benchmark piece. The benchmark does get reset. The way our systems work is, say it is 60 S&P 500, 40 Bloomberg Ag. It gets reset at the end of every month, and then it moves around, and then it just takes that 60 goes to 60.2 times the day's return.
Okay.
That's what the benchmark is. We
That's how
don't
it does.
do anything
Okay.
to the benchmark at all.
Okay, but it is done by the weight as things move, as the value changes some. Yeah.
Yes.
Okay.
Not with
it's
the
reset.
portfolio. I think we need a clarification on that. So when the portfolio moves, the benchmarks, benchmark is staying at that 60/40.
Mm-hmm.
Oh, okay. Is that what it is? Okay.
Oh, sorry, I misspoke then. That's what I meant, that we're not changing anything at the benchmark level. The benchmark's what it is.
Okay.
Yeah. And no, some advisors do that. So that's a great question. Some do. They modify that benchmark.
I've
It's
seen
a
it.
good question.
I have seen it a variety of ways, and it's kind of, and it is kind of funny how advisors can fiddle with that to make things look better. So.
A big part of my job here is also reviewing IPSS and then reviewing performance for our investment committee. And the question we ask ourselves is, what is the benchmark that is given to us as a part of the IPS? And are we outperforming that? So
Okay,
in the client reporting, the benchmark would be what you gave us because that's the governing document. And
yeah,
what you gave
yeah.
us within that, that's what we're trying to show
Okay.
you. And occasionally clients do come back asking for some variations within that, but yeah.
Got it. Thank you.
Mhm. So if you were to change your benchmark for some reason, let's say you were to go to a 70-30 portfolio, we would then begin measuring the performance on a 70-30, whatever that makeup was for the 70-30 benchmark, and it would link back to your old benchmark. So your since inception return would be appropriate based upon the benchmark at that time and the portfolio at that time. So we wouldn't change your historical information performance or the benchmark to a 70-30. We would just link the previous with the new benchmark.
Yeah, thank you. That's kind of what I wanted to know. Thanks.
Yeah.
Mhm.
Yes.
Yeah.
Welcome.
Allison, did you have anything else you wanted to present?
No, that was it
Okay.
for the committee. This has
Okay.
been very helpful. I think our goal, and Suri and I prepared for this with Dave, was really to understand what the committee would like to achieve and then how we would bring to bear a solution that would fit what would make sense for the committee and
Mhm.
for the objectives and allow you to sleep at night and that stuff. So this has been very helpful for us, and I have a few follow-up items. I'm going to check on that IPS and then put together some of the fees for a portfolio that's passive with active on the fixed income side to show you what that would look like.
And then did anyone want anything else to be presented at the next meeting in relation to this? Sounds like, Dave, are you
Yeah,
thinking about
I got
something?
just one more thing. Like if we were going to change something on our, is it called IPS? Is that what we call it? What,
Yes.
yeah. Just the verbiage of what those asset classifications look like. I mean, I think you had it both on, you had it in high, you basically had also a high risk, or I would just want to call it it's the alternative bond thing and then the REIT and the infrastructure, I think is what you called it.
The listed real assets. I don't,
Yeah.
so you have that currently in your investment policy
Do
statement,
they?
real assets. Well, the one I was reading at 2014 had it, but it doesn't have a target. So I would even suggest that even if you stay with your current exposure, if you were to go passive, let's say, we would
Yeah.
suggest putting language in. If you stayed at 60-40, added the high yield, we changed the benchmark for that. And then we would incorporate language in the investment policy to indicate for the equities that we would utilize passive exposure unless the PFM had a recommendation for an active manager in a certain area that we couldn't get
Yeah.
passive exposure, we would come to the committee, but we would retool that language. And I think, and even if you decided not to make any changes, once I get my eyes on the most recent, you should still refresh it so that from a governance standpoint, it's stamped something more recent and that you've reviewed it, and then the committee is in agreement on what your objectives are now moving forward. So until the next time you review the investment committee.
Okay. Thank you.
Sounds good. Allison, would you just like Samantha to send you the policy
That would be
so that
great.
you don't have to spend an hour looking for it?
I've done it. Yeah.
Okay.
Okay.
That would be great. And I'm embarrassed because, well, I didn't get it from our trading operations team. So, and I'm sure they have the most recent one, but I'm going to double check.
It's
So
all right. We understand.
we'll blame it on Dave. He's on vacation. So
Yeah, he may not have, maybe he didn't share that with you. Okay, very good.
right.
All right. Is there anything else? Anything at all? I think we've covered a lot of territory here. It's really been great discussion and your presentation too. So
Well, thank
if
you. Thank you so much.
it's and you'll receive that newest policy. And if there's nothing else, I'll ask for a motion to adjourn.
So moved.
Second,
All right, all those in favor, say aye.
I
Is anyone opposed? I don't think so. We are adjourned. Thank you all so
Thank
much.
you.
Thank you.
Thank you so much.
Thank you.
All right.